Well, hey there, everyone. Happy Friday. It's January 6th, 2026. I almost said 25 again. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming through from an actually beautifully sunny Redmond, Washington. Hope you guys are all doing well and hanging in there wherever you are located. Today, we're going to talk about a couple things about the way that this week finished. Kind of a choppy, sideways, sleepy day to finish this week as we digest that first week of earnings. A lot more earnings, a fire hose of earnings, as it were, over the next 2 weeks. We'll have plenty to talk about. On top of that, all the macro data that is now freely flowing to help us try to understand macro conditions. But really, the purpose of today's episode is a mailbag episode. I always invite you at the end of every episode, and sometimes in the middle, to drop questions in the comments section on our YouTube channel. So many of you followed through, and thank you so much for that. 6 really good questions to go through with you here today, and we'll look forward to it. First, let's get to what happened in the market. So a choppy sideways day. This is one of those where the first hour of trading kind of set the table. So you had the big spike up to around 69.65-ish, a big drop to around 69.25-ish. Then we kind of bounced around quite a bit. In the afternoon, we bounced a number of times off of Thursday's close, which is why I've learned to just keep an eye on that price level. Usually ends up being sort of a pivot point, kind of a key level to pay attention to. So after all that fluctuation, S&P, Nasdaq, Dow essentially all flat for the day. Mid caps and small caps did finish a little bit lower. The small cap S&P 600 was basically underwater through the entirety of the day, and ended up down about 0.33%. So not a big down day. The VIX essentially held steady just below 16. It kind of popped higher going into the close, but still in our low volatility range with the VIX below that 16 level. Rates generally moved higher today, quite a bit in some cases. 10-year yield almost got up to 4.25%. Long bond yields around 4.85. And the TLT was down about 0.6%. The dollar basically unchanged. Looking at the commodity space, gold, silver, copper prices all down. The energy side of the commodity space a little bit better, but not a huge up day anywhere there. Cryptocurrencies sort of mixed here. Bitcoin currently trading a little bit below yesterday's kind of close is what you call it, but it's really just the end of the 24-hour period. Before the equity session, kind of through the equity session, got down to almost 94,000, currently trading around 95,400. That's just down slightly. Mixed results for the rest of them here. Looking at the sectors, none of the sectors had significant moves, but real estate was number one, up 1.2%. Industrials were second, up 0.7%. Then you have energy, financials, technology, all just slightly higher. On the downside, communication services, the worst sector, down 0.9%, healthcare down 0.8%, materials down 0.6%. The breadth was, slightly negative. 57% of the NYSE names were down, 41% up. So while the sectors were kind of even, definitely more stocks down than up today. And then the small cap index, almost a 2-to-1 ratio there. Just quickly looking at some key charts here. Hold on, I somehow switched chartless. How did that happen? We want Magnificent Seven and Friends, don't we? We want this list. All right, let's see. Broadcom up 2.5%. Microsoft up. Apple, Alphabet down. And Alphabet's an interesting one. We were asked to write the CMT ProShares Partner newsletter this week. And one of the things we talked about, I think it was this morning it went out, was the chart of Alphabet. We highlighted on the show yesterday the overbought conditions kind of coming out of that overbought region today, down another 0.8%. So I would say Alphabet sort of in a short-term defensive position going into next week. All right, the S&P 500, 4 of the 5 days this week closed below the open, including today. So, again, while the S&P is at or near new all-time highs, I would say most of this week was not a, wow, this is a raging bull market week. It was more of a, all right, we had the big move on Monday, and then the rest of the week was just kind of backing and filling, right? So sometimes the market is in a directional move, what we call an impulse move. Sometimes it's in a pullback, kind of a corrective move. Other time, it's just kind of backing and filling. I think of it as like a normal distribution. And we're just kind of backing and filling up that space, that price range before the next move happens. So in the short term, we're kind of between 6,900, 6,980 or so. That's kind of the range we've been in the last couple weeks. And that's interesting because 6,900 was the level. That was the ceiling from October and December. We broke above there. Now 6,900 has become kind of the lower end of this kind of short-term range. The 21-day EMA is right about there. So if we would start to break below that 6,900 level, I think that gets back to more of a neutral sort of bias on the S&P, in my opinion. That's where you look down to potential support around 65.50. That has been a key level of support, but I don't see any breaks just yet. We've had a couple pullbacks to the 21-day EMA, but not bad. The advanced decline line making another new all-time high this week. And out of all the evidence I'll be reviewing for my premium members over the weekend, that's one we'll certainly talk about. Breadth conditions still quite strong, even with today, a little slightly lower breadth. The advanced decline lines overall constructive across the board for the most part here. All right, 6 awesome questions I've hand-selected from the many we've received. Please keep your great questions coming. Nothing is out of bounds. I will answer them the best that I can, and hopefully it gives you little nuggets of market wisdom to apply in the coming days and weeks and months. Is there a percent above the 50-day or 200-day moving average that would cause you to become cautious or sell about a stock? Great show. I'm learning a lot. I'm glad you're watching. I'm glad you're learning. Thank you so much for saying that, and I appreciate it. My goal is to kind of inform and educate and inspire people to realize that they can take control of their portfolios and make better decisions. And if something we've done has helped you do that, I'll take it. That's awesome. Thanks for saying that. So you're talking about basically, is there a level above or below a key moving average that would make me nervous, right? So what we can do, let's look at Apple, and we'll go back like 5 years. And I don't have the perfect tool to show you this, but I do have one that would make sense. So this is the PPO indicator. And if we say 1, 200, 1, tell you what, let's do 1, 200, 0. So what this is going to do is give us a histogram. And the histogram is showing us how far the stock is from its 200-day exponential moving average. So we do this and this and this. All right. So this is a 5-year daily chart. This is Apple. And then and this is the 200-day exponential moving average. And, similar to the 200-day simple moving average, which I realize was your question, but this indicator that I have here is based on exponential averages. So it's an easy way to just show the concept, but you could apply this concept to different moving average combinations for sure. What you're saying is right here, if you look at Apple, 20% above the 200-day EMA. If we look back at the previous times when it's been 20%-ish above the 200-day EMA, you start to see a pattern, because that's pretty much where things start to top out. I'll do a little horizontal line here, right? So you can see at the bottom, I'm putting the line around 20. So we can see all those times when it hits like 19 or 20. And if you look up at the price, that's usually at or near a major top. And that is exactly why people use this type of technique. Way more common, I would say, at market tops than market bottoms, although you could do that if you want. But generally, this is something I've seen in practice people applying way more often to market tops. And the reason is because when there's a falling knife acceleration and you hit some hurdle, people are super not excited to buy into severe weakness. However, selling into strength a little more palatable, a little more easy to pull off, to be honest with you. And it's just the ways that that stocks tend to top and bottom a little bit differently. So we'll use that as an example here. But if you look back, I mean, it's not bad, right? So this is exactly why people use it, right? Think about what a moving average is. It's smoothing out the noise of the daily price action and showing you a longer term measure of the trend, right? So if you sort of, close your eyes, squint a little bit, and kind of make the daily bar chart kind of, blurry, if you look at that blue trend line, it pretty much just tells you the major direction of the market at any point, right? And so that's why, thinking about when we're way above that moving average or way below, where, you're talking about mean reversion, right? We're so far away from that average, we're probably going to come back and get closer to it. So that works pretty well. The problem, and I think the challenge with this type of approach, is the time it doesn't work, right? When the stock goes 20%, but then keeps going 25, 30% above its 200-day moving average, when it ends up not being a great corrective move. So I would say something like this can be a great leading indicator. When you think of technical analysis, there's some indicators that are more leading indicators, others that are more lagging. Some indicators tell you anticipating something significant might be happening very soon. And then there are lagging indicators that tell you that thing that just happened was pretty significant and we validated it because of XYZ. In my experience, using a mix of both is very helpful. So I look at RSI divergences, which are a leading indicator. Those tend to signal toward the end of an upward trend before the market is turned lower. But then I also use like moving average crossovers or other techniques that would say, okay, now we've turned down enough that that peak is now confirmed. And that allows you to take initial positions and then complete your position, or sell a little bit and not sell all of it, just in case it keeps going. You still have some on the table. So if you do it right, I think it adds a whole layer of power to your ability to use technical analysis to scale in and out of positions, to anticipate turns, to validate turns, and you have a much more comprehensive view of what a stock is doing. So the short answer is yes, that is a fantastic way to do it. Different stocks have different volatilities. So it's not like 20% is the level. It's the level for certain charts. And so I would say this is more of depending on the type of stock, its natural volatility, its average true range, the percentage that makes sense could be different. So looking at an indicator like this over time and just seeing where has the stock tended to top out, how far does it tend to get above a moving average, that can help inform how you interpret the next move. Hope that makes sense. And great question. And I should note, this indicator that I'm using is called PPO, the percent price oscillator on stock charts. Depending on what charting platform you use, that indicator is called a lot of different things. It could be like distance from the moving average, could be called like moving average momentum. I've seen it called a number of different things, but most charting platforms have a version of that indicator. You just have to kind of poke around and see what it is. And sorry, there's no consistent way that's referred to, unfortunately, but that's the answer. Next question. Since essentially only half of all stock traders beat the S&P 500 average, how do we as non-professional traders outperform the S&P 500 average? You're making a huge assumption, my friend, with that first part of your question, which is basically implying it's a zero-sum game, right? Is it true that half of all stock pickers beat the S&P? I don't know if that's true. And I would say that's a moving target. I would say there are some times, depending on the market conditions and environment, where way over half of traders are probably beating the S&P. And then there are other really challenging periods where way fewer than half are beating the S&P, and it probably fluctuates, right? Depending on the type of environment. What you have to remember is when it was a small, very narrow leadership market, that is incredibly difficult to outperform, because basically people usually don't have enough exposure to those big mega cap names in their portfolio, usually own other stuff. And so that's why big, consistent up markets with narrow leadership, often the most challenging markets to outperform the S&P. Down markets, way easier, especially if you can go to cash, right, and get out of the market and just sort of get out of the way. And that's where most active managers outperform. Money managers are in down markets because they can get defensive and ride out a period of market instability. And we haven't had a good bear market too often since 2009, which is one of the many reasons why I would say professional money managers have certainly been struggling. And that's been well documented, I think, in performance, like the SPIVA report, SPIVA report that comes out once a year and talks about how poor active money managers are at beating the market. Has a lot to do with the cycle that we're in and the particular type of environment. But is there hope for non-professional traders? Yeah, I mean, your level of professionalism in the industry is not directly correlated to your ability to outperform, as much as financial firms would probably want you to think that. I don't think that's true. Honestly, when you think about how many traders beat the S&P, you have to remember these are people traders on different time frames. You're talking about position traders, more long-term swing traders, day traders, and your performance could be subject to a lot of different things. I would argue, for me, it's like this is a similar question to like, is it worth opening a restaurant? Because I've heard like only 25% of restaurants survive the first year or something. I'm making up a thing, but there's that statistic that I've heard thrown around that very few restaurants actually survive the first year, 3 years or something like that. But you don't see a stat of how many well-funded, disciplined owners, fully articulated plan with good decisions on what type of food they're buying and their suppliers and how they're marketing. It's like you're taking all restaurant owners and putting them in a big bucket, and some of them just aren't going to be good at running a restaurant. And that's the problem, is a lot of people start restaurants that probably shouldn't have in the first place. A lot of people get into trading and get into investing and don't know what the hell they're doing. Excuse my language there. And as a result, they get blown up very quickly. There are traders that survive and thrive and learn and get better and better at it. So, if you reframe the question and say, how many traders who have a good money management strategy, who learn how to let their winners run and cut their losses early, who have good discipline and consistent routines, who surround themselves with great resources, who focus on mindset and mental state as they're approaching the market. I don't have hard data on that, but I have to believe that that's better than the broader universe of people. And this is something we found a lot, when I worked at a large money management firm, right? A lot of quotes on how bad active managers were. We actually did some analysis on, okay, how about firms with big research departments? How about firms with XYZ? And we started to look at the characteristics of our approach. And it turned out when you look at the subset of really well-functioning, high-functioning research and portfolio management divisions, they actually did pretty well and beat the market more consistently. So I think that's how I would think of it. All right. It's not that trading is really hard. It's that people go into it with the wrong approach, with the wrong mindset. They don't want to learn. They don't want to focus on learning from poor trades and getting better at it. You just want to like roll the dice and do it again. That's why a lot of people don't do particularly well. But the beginning of your question, I don't know about that 50-50 thing. I would say that is actually a moving target, and it really depends on the environment. I would argue, based on what we saw in 2025, which I think was a very challenging environment, because so many stocks were not really part of the success at times. I think 2026 is setting up to be a much more effective environment. I don't want to say easier, because it's never easy, but I think finding ways to outperform, I think, may come a little more easy potentially. We'll see. Next question: when you manage a couple different portfolios, retirement, personal, kids, etc., how do you decide what stock or ETF goes into what portfolio? If you really like a trade, do you put it in all portfolios? It's a really good question. And I would tell you, standard disclaimer, right? I mean, if, for things like portfolio construction and your investment goals, there are financial professionals that are very well suited to help you work through those kind of questions. I would encourage you to consult someone like that who can really look at your particular situation, what you're doing. And what I'm sharing with you is not advice about how to manage your money by any means. It's more for educational purposes, as always. I'm happy to share, though, what I do in my own portfolios. And the reason is because, to your point, right? I think question number one, or the starting point, if you're an individual manage your own portfolios, number one is thinking about each one of those and what the goal is, right? Most people don't just have one nest egg with one goal, right? For me, like my oldest child is getting ready to go to college next year, hopefully. And so, funding that is one thing I'm trying to do. Retirement, hopefully a number of years down the road, planning for that. I've got another kid who's 9 and at some point may want to go to college or do some sort of education that we need to pay for. Healthcare expenses, right? So I have an HSA, a health savings account that's building up to help pay for healthcare expenses down the road. And then maybe you have other things, right? Discretionary things you're saving up for and all this sorts of stuff. So you have different goals potentially, and different portfolios could be aimed toward those goals, right? Because my first child's going to college in less than a year. I'm going to retire a lot further from now. So the horizon on each of those is very, very different. the way that you achieve those goals in terms of how you manage those portfolios could be very different. So, a lot of my portfolios are long-term, what I call position trading, right? Sort of taking positions, following them over a period of months, if not years, rotating based on momentum shifts and all of that. But I also do some swing trading, right? I have a portfolio that's just a swing trading portfolio. And I do that just because, things happen and I want to take a short-term bet. And so it's more of that. So, so I think the idea of having multiple portfolios with different goals and different mandates and different tools and techniques and strategies used to help you achieve those goals, I think is a very smart way to approach it. So to your point, how do you decide what goes where? Well, I think it goes down to the process. And this is something that I found working with professional money managers. They're a lot better at clearly articulating their mandate, right? They would have shareholders that had an expectation about what a particular fund would do. And so we would have a new portfolio manager write out a one-pager kind of document. And there'd be this iterative process to how do I define, how do I explain to someone, here's what the fund is, here's what I'm trying to do with the money, here's how I'm going to do it, here's how I'm going to manage risk, here's how I'm going to think about position sizing, here's the information I'm going to use, here's the team I'm going to use. And it sort of lays it all out. And most individuals, formally or informally, do not go through that process. And I think that just opens you up to making mistakes and not making good decisions about answering those questions, right? So I actually encourage people, when they have a portfolio, write out a one-page thing, even if you don't share it with another human being. Force yourself to articulate what your process is, how you're going to generate ideas, how you're going to manage positions, how you're going to think about risk. Are you going to keep positions overnight or through the weekend? All those kind of questions, and just lay it out, and then make an intentional decision about how you're going to stick with that process over time. So for me, when a stock comes up, usually for me, I'm thinking of a position trading timeframe, because that's kind of the bulk of what I'm doing is sort of along those lines. But if I see something that's just more of a mean reversion trade, right, like an Alphabet that's gone up and pulled back a little bit, and maybe I want to make a trade. And I don't own a position in Alphabet, but maybe I bet a little mean reversion, pulling back to a mean. And I've done that at times with like an inverse ETF on the Nasdaq, for example, betting on a short-term pullback. So honestly, I mean, that was a long-winded, far-ranging answer to say it depends, right? And I think that's the challenge for individual investors, is going through and getting away from a very undisciplined, just trying to throw spaghetti at the wall and see what sticks and what doesn't, versus having a well-articulated, very consistent game plan. And I will tell you that a lot of times that's what separates amateurish, unstructured investment processes with more professional investment processes. It's the consistency, it's the discipline, it's the communication. It's having to communicate to another person, here's what I'm doing and why. At the CMT event in Tampa, by the way, last week, we had a number of financial planners, wealth managers that use technical analysis that talked about them. Not a single one talked about how undisciplined their process was. Every one of them was about, here's how we manage risk, here's how we do this, here's how we think about this when we have a new idea, here's how we vet it and put it in a portfolio. And I would strive as an individual to have that level of rigor and discipline to your own decision making. So there could be opportunities where the same stock is in different portfolios, but most of the time it's based on the particular mandates, and that's how I would think of it. All right, we've got a couple more questions to share with you, but I do want to let you know we did our 2026 market outlook earlier this week. It's only for our premium members, the Market Misbehavior Premium membership. You can find more info at marketmisbehavior.com/premium. The goal with the premium members is to take a small subset of my followers and really dig into some of the good stuff in terms of virtual courses, teaching you a more structured approach to learning technical analysis and behavioral finance. Reports only, like our market outlook series, our monthly chart review, our weekly flight plan, are all just for premium members. And we have a community that's pretty awesome, and people are in there every day asking questions. And I love going in there and answering questions of my premium members at any point. Great place to share charts, share ideas, and learn from one another. You can access the market outlook today with some of the key themes that I'm seeing and some of the charts I'll be following, along with all the other member benefits at marketmisbehavior.com/premium. Would love for you to check it out today. By the way, don't forget to use the code YouTube when you check out for 30% off your first 12 months on any plan. Question number 4. You mentioned you watch the VIX above 20 as a warning sign, and your other big warning is the bond markets. What do you watch for specifically as a red flag for bonds? Great question. So two things that I would tell you. Let's see, and I will actually group a second question into this because it's so similar. Hi, Dave. You mentioned widening credit spreads as a warning sign for you. Would you look at a ratio chart like would a ratio chart like TLT to JNK, which is Treasury bonds versus high yield corporate bonds, would that suffice to show this, or do you have a preferred chart? What do you look for exactly? So I'll group the two of those together to just talk a bit about the fixed income markets. And my goal, honestly, when I talk about the fixed income markets, I think this is a blind spot for a lot of investors. Most people kind of know equities and know ETFs because that's what you trade. You probably did not trade the bond markets, or maybe don't know people that have. And it's a whole different world in so many ways in terms of what you focus on and how you go about your day and your process of investing. And my goal is to try to bring some color and understanding of that area of the market, but not make it so painfully boring that you decide to switch the video off and go do something else with your time. So with that in mind, let me share with you. So number one, 100% right. The VIX is a key thing that I watch. And as you alluded to, volatility spiking above 20, the VIX pushing above 20 is a red flag for me. And again, I'm a big fan of kind of setting a level like that. Anything below 20 is just not that big of a deal. Anything above 20 might be a bigger deal, and I want to pay a little more attention to it. That has served me well, just recognizing a VIX above 20 as a potential issue. The bond markets, it's with credit spreads, which is the other thing that I mentioned. But there are two things. Number one, there is a move index, which is kind of like the VIX for the bond market. So what the VIX is doing is looking at the S&P 500 index options, looking at the volatility of those options to imply a volatility for the S&P, right? So it's the options market is pricing in essentially a certain expected volatility of the S&P, and that's what the VIX is really showing us. The move index is kind of doing the same thing, but for bond futures, bond and options related to those. So the move index is kind of like the VIX for the bond markets. Now, do I watch that as closely? I do not. Would a spike in the move index cause me to make a significant change? Probably not as much as the VIX, because that is more the area that I'm looking at. But if I traded bonds, I would probably look more closely at the move index as a measure of volatility. You can, obviously see both of these are at the lowest levels they've been for the last 12 months. So no real warning signs from the bond markets or the options, equity options market in this particular case. So that's one thing that I would look at. The other thing that I look at, though, is this chart of high yield spreads. So spreads, so what you have to remember is bonds are traded on a spread over treasuries, right? So you quote bonds in terms of how many basis points over a treasury bond, right? And it's just the way that they're kind of traded. So a treasury bond has a certain yield, and so a corporate bond trades at a certain spread, a yield spread above the spread of the treasury bond, right? Because a treasury bond is, low risk. It feels at times here recently with the volatility of the U.S. government, maybe a little less than low risk, but it still is generally, meant as considered a low risk bet, right? So it has a certain interest rate. But a corporate bond, you're taking on additional risk because a company is, either, slightly less likely or much less likely to be able to meet their debt obligations as the U.S. government. The U.S. government can essentially print an endless amount of money, so highly unlikely they would not be able to pay the coupon payment on a treasury bond. But a blue chip company trades at a very small spread above treasuries because a big, well-established company probably has plenty of cash available. It's going to be pretty easy for them to pay their coupon payments as well. But a junk bond, a high yield bond, is a bond of a riskier company with less cash, and the ratings agencies have classified them as higher risk, and as a result, they're probably more likely to be unable for some reason to meet their debt obligation. Maybe they have a lot more debt than others. They don't have as much cash. Their business is unstable. Whatever the rating agency would interpret that, they get a lower rating, and then it's classified as high yield or a junk bond. But all of that is to say they traded a spread above treasury. So this is an index created by Bank of America and distributed by ICE, different ICE, the Intercontinental Exchange and it's a high yield index option adjusted spread. An option adjusted spread, a lot of bonds have like call options where they can be called at a certain point. So this basically means you look option adjusted. So you look at all the different bonds on an apples to apples basis, and you calculate, it's an index that they calculate based on the spreads that a bunch of different bonds are trading above treasuries. So if this number is higher, that means bonds are trading at a wider spread, which means fixed income investors are getting nervous and are requiring more compensation, higher yield above treasuries to buy, to own the debt of these risky companies, because the chance of them defaulting on the debt is higher. When the spreads are very narrow, as they are now, that basically means the bond market is not seeing as much of a risky environment. They see it much less likely that these companies would be unable to meet their debt payments, and as a result, you don't need as much of a spread above treasury bonds. So I would say high yield option adjusted spread. This index is one that I've been following for years, and I've tracked it to sort of track that. So to sort of track that sense of risk in the bond markets. So this chart in particular is one that I look at every week, and in fact most mornings as well, because it shows me high yield spreads, which is essentially a version of credit spreads. It shows me the VIX, volatility, and then I see the S&P at the bottom. And I have these two series plotted upside down because when spreads are widening, that tends to be bad for stocks. When volatility is increasing, that tends to be bad for stocks. So my goal is basically to be thinking about the trend in the S&P, so you can see that these lines tend to move together, right? When spreads are narrow, when volatility is low, stocks tend to be good, and the opposite, right? Here in early 2025, spreads start widening, volatility starts increasing. That's as the market sells off of a major top. So at this point, not much of a warning sign, although the volatility is trending higher over the last couple of weeks. It's still pretty low. Spreads have been generally narrowing over the last month or two. And so these indicators are both kind of good. So the answer to both your question is I watch those couple charts. I don't really look at the TLT to JNK ratio. If you look at JNK or HYG, those are two high yield bond ETFs. They track stocks pretty well, to be honest with you. So I don't pay as much attention, but that is another thing you could do. But I think credit spreads are a little better. Platforms like Bloomberg, or if you have access to like an institutional platform, they have way more cool, super granular stuff looking at different spreads, looking at CDS rate, credit default swap spreads, and all these sorts of things. And I miss having that sort of color on the fixed income markets, but this is good enough for now. Last question, then we'll call it a week. Looking at the weekly chart of Target, I was wondering if you would ever draw a straight line along the few highs. Would that be helpful or not relevant anymore? Let's look at a weekly chart of the Target. We featured this, might have been yesterday on the show because of this nice rotation higher. So you're saying on the weekly chart, I think what you mean is, would you draw like horizontal lines from some of these other major highs? So the answer is for sure. But here's a couple things that I would say about it. When you're looking at a stock like Target, this is why I show the dividend yield on the top of my charts here on Stock Charts, and any other platform I use. I want to get a couple things up on there. The market cap is super important to me. The dividend yield is super important. Earnings dates are important. These are good things to know. PE, less for me, but still kind of interesting to see a little bit about the valuations. But dividend yield is important because you have to, I think you want to think about stocks on a total return basis. Am I getting, by owning this stock, do I have an expectation of capital appreciation, dividend income, or a mix of both? And I think that's important to know up front. So if you're looking longer term, and if you're looking at support and resistance levels, you want to do unadjusted data. So here you can see it says adjust for dividends. I'm taking that off. And the other thing you can do is just switch the ticker. So on Stock Charts, you can add a little underscore before the ticker. So what happens is when a company pays dividends, that dividend is paid out from the price of the stock. So the price of the stock will come down a little bit. Stock Charts default, and some platforms default to adjusted data, where you adjust all the historical price data based on that dividend payout. Others default to not total return charts. They actually show just the price itself. It's really more of a preference thing. There's a big debate among my peers in the industry as to which one is better and why. Honestly, it depends on what you're doing. If you're analyzing returns, if you're analyzing relative performance, adjusted charts, I would say, are absolutely vital because that tells you the total return in one stock versus the other. But if I'm doing Fibonacci retracements or support and resistance levels, anything that's more based on price or honestly indicators, sorry, not indicators, but price measures themselves, it's good to look at unadjusted data because this is actually showing you the price where the stock was trading at historical points. Now, having said all of that, like I'm just doing some historical lines. Like, I mean, yeah, right. I think it's helpful to see this is where Target topped out in the second half of 2022, early 23. We kind of got right back exactly to that level in 2024 before going down here. So like looking at some of these levels and recognizing that support and resistance works is super helpful. Most recently, up here, you have the significant top here, the double top around 265 to 270. So, are these levels still relevant? Like, yeah, right. I think in general, right, you start to the right and look to the left. I wouldn't start to the left. This is a mistake a lot of people make. You don't start on the left and read right. You want to read right to left. Look at the current price and go back. Look at the prices that stick out. Those are your key support and resistance levels. Look at levels where that are more of a pivot point, levels that have been tested multiple times. Those are important. Is this level back here meaningful? I would say 100% absolutely not. Like, I don't think this peak right here makes a ton of sense. So if we've been in a downtrend, look at the peaks that are sticking out. Those are the levels of resistance I probably want to be paying attention to. The more that it's hit that level, the more meaningful it is. The more that it's tested, the more valuable that might be. So the other thing I would say, just to clean it up for a second, is also I encourage people to think about support and resistance not as absolute levels, but more as ranges. So, like this, for example, I would think of like this. Oh, sorry, you can't even kind of see that. Hold on. There we go. So, right, I wouldn't think of it as like an absolute price level. I would think of it more of as a range. So like here, like 255 to 265. There are a number of peaks right around that level. So keeping an eye there, because that was tested multiple times, I think super helpful. So I like to draw them as little rectangles on the chart because I like to think of it as a little wiggle room. Like it's a range. It's not an absolute level. A lot of techniques built around support and resistance were created decades ago when stocks traded on like 1/8 increments. So there was a reasonable expectation that a price would hit an exact level and bounce because there were only 8 levels to every dollar. But we're now at sub penny spreads, right? And sub penny execution. And so I think it's more ranges than absolute levels in 2026. Maybe that's just me. Folks, that'll do it. Thank you so much for those awesome questions. I hope that this discussion and these answers helped you understand a little bit more about some of these concepts. If things I showed you today elicited more questions, hey, it's never too late to go to the comment section on our YouTube channel and ask your question there. Reminder, check out our premium memberships. You get access to our market outlook and a lot of great members-only content at marketmisbehavior.com/premium. And don't forget to use the code YouTube when you check out for 30% off your first 12 months on any of those plans. Also, the Market Misbehavior podcast, some awesome interviews this week. We sat down with Jason Shapiro, a market wizard and fantastic swing trader, and trader basing a lot of his work on contrarian plays, the Commitment of Traders report. Talked a lot about mindset as well. Also, had a really good interview with Matt Tuttle yesterday. That's not quite posted. That should be posted tomorrow morning, I think. But a great interview, Tuttle Capital Management, sort of a market outlook, 5 key themes kind of discussion. It was really, really good. And I think you're going to enjoy that as well. That's it for today. Have a great weekend. We'll be back on Monday. In the meantime, actually, we will not be back on Monday because it's a holiday, but we might put out a different video instead. But keep an eye peeled on our YouTube channel. We'll be back with this show on Tuesday after the next day of market action. Have a great long weekend. And remember, it's always a good time to own good charts. Take care, folks.